Hello options traders, and welcome to another Facebook trading tutorial. And as promised, this is going to be Greek week. And I want to touch on some of the key Greeks during this week. We actually might roll into next week, but I want to make sure that everybody's up to speed with the basics of the Greeks, how to interpret them, and how to use them strategically, because they will be important once you get more advanced with options trading. So let's get started with today's Greek, delta. First of all, there are 5 key Greeks that you need to understand. There's delta, gamma, theta, vega, and one called rho. I'm not going to be touching on rho because, quite honestly, at least for the US, it's not real important. It has to do with an option's sensitivity to interest rates. Because our interest rates are fairly low and fairly stable, doesn't really play a big part in options. It can for longer dated options, and certainly if you're dealing with currency options, especially in countries that have runaway inflation, rho could be one of your biggest risks. But I don't want to minimize it and make it sound like it's absolutely not important. But to get started, we're just going to focus on these first 4. For today, it's just going to be delta. Now, as a side note, these aren't the only Greeks out there. There are what are called second-tier Greeks, and there are even third-tier or tertiary Greeks, all important for options and for strategies. But these are the ones that probably 99% of the people use 100% of the time. These are the ones you have to know. So let's get started with delta. First of all, where do these Greeks come from? Well, the Greeks are actually outputs from a pricing model. I think most of you have probably heard of the Black-Scholes pricing model, certainly the most famous of all the pricing models. There are others, but the way it works is, take a look over here on the left. We have stock price of 100, strike of 100, volatility 20%, interest rates, let's say, are 3%, no dividends, and then down here, days till expiration. And if you give the model those inputs, over here on the right, look what it tells you. That call option should be worth about $3.45, and the put should be trading for 3. Now, those prices that you're seeing are actually what are called the theoretical price, also called the fair value, another critically important topic in options, because you're going to hear most traders say, well, an option priced at $3 or below is pretty cheap. That's a pretty good deal. If they're above, it's too expensive. Absolutely not true. It all depends on the volatility that you're getting for that price. So we have to understand that the fair value means it is the price that is fair to the buyer and the seller. And interestingly, the fair value also means it is the price at which the buyer and seller are expected to break even. If we were to buy this option for $3.45 or to buy this put for $3, and we did it hundreds and hundreds of times under these exact conditions, not counting commissions, we would just break even. If we sold those options for these prices, we would just break even. So another important point to understand from a pricing model is that it is absolutely incorrect to say that sellers have the advantage. And I know you hear that a lot. Everybody thinks you're better off selling options. Absolutely not true. If they are priced according to fair value, there is no difference between the buyer and the seller. Now, can there be a difference from any given expiration or strike? Of course, that's what options trading is all about. But in the long run, it's absolutely incorrect to say that one side is always favored. If that was true, that price would continue to be sold until it was no longer favorable. So that's what we're looking at right here, are what are called the theoretical prices. But take a look down below that. Delta, gamma, theta, vega, and rho. This model actually uses one that's called a 7-day theta, which is, loosely speaking, the theta multiplied by 7. But the main thing I just want you to see right now is that these Greek measurements, delta, gamma, theta, vega, rho, are all outputs from a pricing model. That's where those numbers are coming from. All of your options brokers platforms are going to show them to you. Here's a screenshot of E-Trade, and look right here. Delta, gamma, theta, vega. It does have rho. I just choose not to show it for the reasons I just talked about. But you can put them on your platform, and you should. Unfortunately, most people just completely ignore this because they usually don't understand what they mean, and they're missing some very big benefits about selecting your strategies. That's why traders look at these. So this is where these numbers are coming from. They are mathematical outputs from a pricing model. And another important point to understand is that there are lots of different pricing models. or slight tweaks we could make to them. So you might be on the phone with your friend and say, what's your delta showing for this 141 strike on IBM? And they might have a little different delta. Doesn't mean one person's right or wrong. It just means that they're using different pricing models. But they should be very, very close. So the first thing about delta, let's take a look at some definitions. There are several definitions and ways to understand delta. Let me show you the two most important, be the most helpful. First one, delta represents the amount the options price will change for a $1 move in the stock. Second definition, it is the probability for the option to expire in the money. Don't confuse that to mean it is the probability for profit. We're just saying it's the probability that the stock price gets above that strike in the case of calls, or that it falls below that strike in the case of puts. But it is, roughly speaking, the probability. It's not exactly. There's another measure, it's called the dual delta, that will give us the exact probability. But it's very, very close, and it will help you to understand which options to buy and sell depending on your strategies. So let's take a look at how this works. Let's say that IBM's 140 call has an options price of 3. That's the premium that we would pay for that option. But we look at our broker's platform and it says it has a delta of 60. Now another point to understand, some platforms are going to show delta as a decimal. It might show 0.60. But because each contract controls 100 shares, it might show it as 60. It means the same thing. So our stock, let's say, is trading at 140. So if the stock were to rise $1 right now, and that's important, not 15 minutes from now, not tomorrow, not next week, right now. It's what we call an instantaneous jump. If it moved $1 right now, that options price would pick up 60% or 60 cents of that $1 move. So instead of trading for 3, we should see that call trading for about $3.60. Obviously, if it works on the way up, it's going to lose by that amount on the way down. So if we bought that option for 3 and the stock instead fell $1 right now, we would expect that 140 call to be trading for 60 cents less, or about $2.40. So the delta shows us how sensitive that options price is to changes in the stock's price. For put options, the concept is the same, a little bit of a tweak here. Put options have negative deltas. And that's because, as you'll see a little later in the presentation, put options are a way to get short shares of stock. And as the stock price falls, you'll actually make money. So their deltas are negative. Easiest way to think of that is that they benefit from falling stock prices. But the concept is exactly the same. Let's say our stock is at 140. We bought this IBM 140 put for $3. If the stock price rises $1 right now to 141, we're not going to gain $1, are we? Because we have negative deltas. That's going to be bad for us as the owner of a put option. How much do you suppose that put option is going to lose? Delta of 40. It's going to lose about 40 cents, and it should be trading for about $2.60. Conversely, if the stock price falls $1 right now to 139, that 140 put is going to pick up about 40 cents. So it should be trading for about $3.40. So just remember that call options increase their prices as the stock price rises. Put options increase as it falls. And once you get your bearing straight, just look at the delta and it will tell you by how much that options price is going to change. So why does this happen? A lot of times new traders say, it's kind of weird. Why don't the options move dollar for dollar? Well, it would actually be too good of a deal if it was. And to understand why that happens, let's take a look at a simplified model. Let's assume that our stock price right now is trading for 100, but we're also going to make the unrealistic assumption that it can only rise or fall $5. So it can go up to a maximum of 105 and it can fall to a low of 95. And the reason you have to put that in there is it gives us some sense of volatility of stock price movement. Again, it's just to make the concept. So we know that the stock can move somewhere in this range. Now take a look at the second column right here. If we get to expiration and the stock is 100 or below, the option expires worthless, right? The call option does not have any intrinsic value at expiration unless the stock price is greater than that strike. If the stock gets to 101, the table tells us the call will be worth $1. Stock price of 102, it'll be worth 2, and so on, all the way up to a stock price of 105, where that option would be worth 5. This highlights another important aspect of options pricing. When you are at expiration, all options are worth either 0, if they're out of the money or at the money, or they are worth their intrinsic value, and there's no in between. It's either 0 or intrinsic at expiration. So here are all of the possible stock prices we could have at expiration. I'm going to include another unrealistic assumption and say that all of these stock prices on the left have an equal chance of being hit. And of course, that's unrealistic. A stock at 100 has a much better chance of falling to 99 or rising to 101 than it does to go to 95 or 105. But again, for simplicity, let's assume that all of these stock prices are equally likely. And if that's true, the average price of these expiration values would be the value of our option. So in the second column, I've got 11 different values. And if we were to add those up, I'd get a price of 15. And if I divide that by 11, I would get $1.36. The option's theoretical value is $1.36. Why? Because if we did this hundreds of times, you would just break even, whether you were the buyer or the seller. It's the fair value. So now keep that $1.36 price in mind. Now let's assume the stock price rises one full dollar to 101. If we keep with our previous assumptions that it can either rise or fall $5, the lowest point it can go to is 96, and the highest it can go to is 106. So now look at your expiration values. Now, if the stock stays where it is, it's worth $1. It goes to 102, it's worth 2, and so on up to 6. So now the option has the ability to become worth 6. And notice it's only worthless in 5 different cases. So now what's the option worth? We add up all those values, adds up to 21, divide by 11. The option is worth $1.91. That would be the fair value. Well, how much did it increase? Previously, it was worth $1.36. What's the difference? The difference is 55 cents. And what that tells us is that for an at-the-money option, at-the-money meaning the option's strike equals the current stock price, which is what we assumed here. The stock was trading for 100, we bought the 100 call. Stock rises $1, we picked up 55 cents. And in the real world, you'll see an at-the-money option will have a delta very close to 1. Reason it won't be as high as I have here is because we're making the unrealistic assumptions about each stock price being equally likely, but it's going to be close. So the first thing to understand is that your at-the-money options move roughly 50 cents on the dollar. Their delta is about a half, or 0.50, as you'll see on your broker's platform. Now let's take a look at an in-the-money call. So if our stock price is 106, and we've got the $100 call, there's $6 of intrinsic value. That's an in-the-money call option. So once again, we're going to assume the stock can either rise or fall $5. That means the lowest price could be 101, the highest could be 111. But now look what's happened. The option has no chance of falling out of the money. It always has value. In fact, it can be worth a low of 1 and a maximum of 11. What's it worth now, theoretically? Well, we add up all those prices, we divide by 11, it's worth $6. So keep that $6 price in mind, and let's advance the stock price by 1. Now we assume the stock price rises $1 to 107. Look what happens. Now the lowest value that the option can be is 2. We now dropped off a 1 and we added a 12 on top. So now the option must be worth more money. So now if we add up the second column of potential option prices and divide by 11, we get 7. So if the stock moves from 106 to 107, one full dollar, that option's price goes to 7. Previously it was worth 6. What does that mean? It means the option is picking up dollar for dollar with changes in the stock. Its delta is 1. In other words, the in-the-money options have prices that respond quickly, and you're going to find their deltas are relatively high. In the real world, looking on your broker's platform, you're probably going to see in-the-money deltas somewhere around 65, maybe up to 90. Can they get up to 95 or 100? Sure, you're going to have to go super deep in the money, or as you get closer to expiration, they will definitely hit 1. But if you have 30 or 60, 90 days to expiration, even a week, especially on a high volatility stock, they're probably going to be somewhere around 65 to 90. But the important point is that the in-the-money options are relatively responsive to changes in the stock's price. Now let's take a look at out-of-the-money call options. We're going to assume the stock is down here at 94. We still have the $100 call. Stock can either rise or fall $5. Look what happens. Doesn't matter where the stock goes, that option's worthless. It has no chance of having any value. So what's it worth? Well, not real hard to figure out. Nobody's going to pay you a thing for it. It's worthless. What if the stock price rises to 95? Still, we make plus or minus $5 of stock price changes, still a board full of zeros. What if the stock rises another $1 to 96? Well, now we pick up this little 1 down here at the bottom. If the stock gets all the way up to 101, we have a total of 1. We divide by 11. That's worth about 9 cents. So think about what happened. The stock had to go from 94 to 95 to 96 just to pick up 9 cents. So the point to understand about your out-of-the-money options is that price changes are slow. This is the danger of trading the out-of-the-money options. I talked about that the other day when we talked about the why did my option lose money. At-the-money and out-of-the-money options have very slow price change responsiveness. That's why I said to go in the money. And if you're looking at your broker's platforms, you'll see that the out-of-the-money options will all have deltas below 50. So how can we use the Greeks for better options trading? Well, first of all, understand that all of your Greeks are measurements of profit and loss diagrams. If you're not familiar with profit and loss diagrams, there is another video in here called Profit and Loss Diagrams, and it will explain them to you. But your broker's platform will show you the shape of that expiration graph and the current graph depending on your strategy. And these Greeks are just measuring those price changes. So for instance, if you have shares of stock, this is what your profit and loss diagram looks like. It's a straight line and always will be. So let's say the shares are trading for 50 and they rise to 51. Well, your long stock position is going to pick up $1. If it rises another $1 to 52, your position picks up $2 total. If the stock moves from 50 to 53, you pick up $3. Stock gain 3, you gain 3. Stock gains 2, you gain 2. You're always dollar for dollar up. That's a delta of 1. What happens if the price falls? Dollar for dollar. Let's say it moves from 50 to 48. That's a 2-point fall. You're going to lose $2. So you're always dollar for dollar if you own shares of stock. It can be a benefit, but it can also be a huge risk, as any stock traders know. And one of the key tenets of financial risk management is to avoid extreme outcomes. We don't want conditions where we can make it all or lose it all. And options allow us to partition these risk-reward profiles to get a much better risk-reward profile for our needs. So now take a look at various stock positions. If I have 20 shares of stock in blue, I'm going to have a very flat risk graph. Stock moves up 5 points, I pick up $100. It's not very sensitive. That graph is very flat. If I have 100 shares in yellow, dollar for dollar. If I have 200 shares in green, I'm now delta 2, delta 200. In other words, if the stock rises $1, I pick up $2. If I have 300 shares in red, or 300 deltas, stock moves $1, I pick up $3. So notice that as that number of shares that we control increases, or the number of deltas increases, we become more sensitive. And that can be a good thing. It can also be a risk. And as you become better with options trading, you'll find out how you can mitigate that by doing rolls and hedges and morphs depending on how things change. But right now, I just want you to see what's happening with delta and what that means. The bigger the delta, the more vertical that profit and loss profile gets. Short shares of stock should now make more sense why you have negative deltas. We need the stock price to fall $1 in order to gain $1. So if we're short 100 shares of stock, we have this negative sloping position. So if your profit and loss diagram is leaning out to the left like this, it's negative deltas. But because it's a short stock position, it's always delta 1, or in this case, delta negative 1. Now let's take a look at a call option. In yellow, is a $50 call at expiration. And you'll see it has this hockey stick shape. And that's because we make dollar for dollar only if the stock price is above our strike at expiration. Only then do we behave like shares of stock. And that's why that angled portion of that yellow line looks like a long stock position. However, if the stock falls below our strike of 50, worst that happens is we lose the amount we paid and we flatten out. And that's why we have that flattened portion over here. Prior to expiration, we don't look like that. We're going to look like a curved line, something more like this in red. So let's say that the stock is way down here at perhaps 40. What's our delta of this option? Keep in mind it's an out-of-the-money option. It's a $50 strike. We always get a bend at the strike, and we can see in that yellow line that's where it bends. So the stock is 40. We're 10 points out of the money. What's our delta? Where is that coming from? What the computer is doing is it's measuring your profit and loss diagram, the slope, but only right down here. So think of this. If we were to take a very small ruler and put two little dots down here, maybe one right there and one right there, because we want to be right there at 40. And I laid that ruler and I traced a straight line right through those two dots. And I measured that, and I might say, you know what, that looks like 20 shares of stock. We would have 20 deltas. But notice we don't always have 20 deltas. It's going to change because look at that red line. It curves. As the stock price starts moving to the right, we start moving up that red line. And that means the angle or the deltas are going to change. So it's important to understand when you're looking in your broker's platform and it says in this example your delta is 20, it's only talking about a very small range. It doesn't mean your option's always going to be 20 delta. On the other hand, let's say the stock is getting closer to 50, getting closer to at the money. What's your delta now? Again, the computer's going to go in there and it's going to measure the slope or the deltas. In other words, how many shares is it behaving like, not through that whole range in red, but just right in here. And so if we put two dots very close to each other and we were to measure that, we'd see that it's leaning on an angle about like this, more like 50 shares of stock or 50 delta. So in other words, that option position right now, even though it used to behave like 20 shares of stock, has now increased to 50 shares of stock, but only for this very small portion. If the stock moves up or down, it's going to change. Let's say the stock rises way up here, maybe to 57 or so. What's your delta now? Again, put two small dots real close. We're just measuring this tiny area. And we connect those two dots. And we measure it and we say, that looks about like 90 shares of stock. Well, it's going to report a 90 delta because that option is behaving right now like 90 shares of stock. But the key point to understand is that those deltas will change. And that's why it is absolutely wrong when new traders say, oh, I've got a 70 delta. So if the stock moves up 10 points, I'm going to have a 70 delta. Or if it falls, I'm going to still have a 70 delta. You will not. Those deltas are going to change as the stock price changes. Once the stock price moves, technically even by a little tiny amount, but let's just say up $1 or down $1, you don't have the same deltas anymore. You're sitting on a little different area of that red line. Let's take a look at a real-world example. Here's IBM trading for 144.30. So if we looked at the 144 strike, would be close to at the money, and we would expect that delta to be about a half. Now, technically, there's a little bit of intrinsic value here of 30 cents, but take a look at the delta, 55, almost 56. What happens if we go to lower strike calls, or in other words, more in the money? Those deltas increase, 69, 80, and 86. If we head in the other direction and look at higher strike calls, the deltas decrease. We go 39, 24, 12, and then down to about 8. They are becoming far less sensitive because they are out of the money. So let's pick one as an example. If we bought this 144 call right here for $1.05, and we see that the delta is 55, what does it mean? If the stock makes a $1 move right now, that option is going to pick up 55 cents and be trading for about $1.60. If the stock price falls $1 right now, that option is going to lose about 55 cents and be trading for about 50 cents. Now we just saw that deltas change depending on where the stock is, is there a way to measure how sensitive the delta is? And the answer is yes, but you'll have to wait for the next video. For those who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course at optionsatoz.com, or you can also instant message me here on Facebook.